Hi guys, my name is Esther from Allison Tutors, and today I'm going to be presenting on revenue and cost concepts as well as output, particularly under perfect competition. Okay, so the first section is talking about the individual business and the industry. So, an individual business is basically a single standing entity that focuses on producing goods and services so as to satisfy human needs and wants. However, when we are looking at an industry, it's basically the sum total of the output of all the individual businesses. So I'll give you an example. I'll particularly focus on the clothing industry, right? When you're looking at the clothing industry, it comprises like shops like your Legit, The Fix, Mr. Price, etc. However, if it is an individual business, then it's just one business, maybe like Mr. Price, right? Now, when you're talking about perfect competition, you need to know that the players in this industry, they basically produce homogeneous goods, meaning to say that they are similar, right? And therefore they'll be sold at the same market price. Now, individual businesses are just price takers. However, the market price is actually influenced by the forces of demand and supply, which is why you see that we have a horizontal shaped demand curve, as you can see over here. Now, let us move on to different revenue concepts and curves of the businesses in a perfectly competitive market. So, I'm going to focus on the total revenue, the average revenue, and the marginal revenue. So, total revenue is basically the total income that a business received from selling a specific quantity of goods and services at the market price. So, for us to calculate total revenue, we say price multiplied by the quantity sold. Then, for average revenue is basically equal to the total revenue divided by the quantity sold. And for you to calculate this, it's basically total revenue divided by the quantity being sold. Marginal revenue is defined as the additional revenue that is earned when one additional unit is sold. And how do we calculate that? We say the new total revenue minus the new total revenue minus the previous total revenue divided by the new quantity sold minus the previous quantity sold. I think this actually makes sense when you're going through a tabular example. So I'm going to use this example over here. Okay, so in this particular example, my quantities range from 0 to 6. The price is constant at 5. So in this column, I have the quantity. In the second column, I have the price. In the third column, I have the total revenue. In the fourth column, I have the marginal revenue. And in the last column, I have the average revenue. So let us start with the quantity of 4. So if I have quantity of 4 and then the price is set at 5, it means the total revenue is 20. Then for me to get the marginal revenue, I say the new total revenue minus the previous total revenue, thereby giving me 5. Then for me to also calculate the average revenue, I say the total revenue divided by the quantity, right? So basically this is how we are going to do it. Okay, now let us have a look at the revenue curves. So the revenue curves are basically a graphic representation of the total revenue, the average revenue, and the marginal revenue for a particular firm or industry. So they actually help us to understand what is happening to the revenue over a period of time. Now, when we're talking about perfect competition, we are mainly focused on where do we actually maximize profit. And we maximize profit at a quantity where your marginal revenue is equal to your marginal cost. Now, we can actually equate this to your normal profit. I'm also going to talk about there are certain cases whereby the marginal revenue is actually greater than the marginal cost, right? Excessively greater, by the way. So the marginal revenue actually be contributing towards the total profits. And by producing and selling an additional unit, the producer gains more than it costs to produce that additional unit. Therefore, the profits increase. Now, for this to make sense to you, when COVID-19 hit, the people who firstly started selling things like your masks and your hand sanitizers, they made loads of profits, right? Because there were very few players in that particular market. Therefore, they were actually making what you would want to call supernormal profits. And in this particular case, their marginal revenue was excessively greater in comparison to the marginal cost. However, when more players started to enter into the market, the profits actually started to decrease. So this brings me to the next point. When the marginal revenue is less than the marginal cost, the total profits will decline. So it is actually costing the firm more to produce an additional unit than it gets from selling the additional unit. So we're basically saying that the profits will start to decline. Now let us go on to different cost concepts and curves of businesses in a perfectly competitive market. So in order to receive revenue, businesses should incur costs. So these costs are actually expressed as total costs, average cost, and marginal cost. Remember, in every business, we have the short run and the long run. In the short run, the costs are divided into fixed costs and variable costs, right? And when we combine the fixed costs and the variable costs, we get what we refer to as the total cost. In the short run, fixed costs can't be changed. In the long run, all costs are variable. This is a very important point, and I would advise one to take note of it. Now, let us have a look at the cost concepts. Remember, your total cost is equal to your total fixed costs plus your total variable cost. The diagram that we are shown over here, it applies when the business is still in the short run, because remember, that's when we have the total fixed costs being fixed and stagnant at one point. Now, the average costs, you calculate them by saying total cost divided by the number of units produced. At the same time, average costs are an aggregate of the fixed costs and the average variable costs as well. Okay, now I'm going to look at output. So, in a perfectly competitive market, the business main objective is to maximize its profit, right? Now, remember, it can't change the product's price. However, it needs to decide if it should continue with production or close down its operations. Also, if the quantity that it needs to produce, it's it also needs to decide on the quantity that it needs to produce so as to maximize its profit. Now, how does the business maximize its profit? Profit maximization is done through marginal revenue minus the marginal cost rule, right? So this says that the business should produce at a level of production where the marginal revenue is equal to the marginal cost, and also the total revenue minus the total cost approach. Therefore, it should produce at the level of output where there is the largest positive difference between the total revenue and the total cost. So these are the ways in which the producer can actually maximize his or her profits. Now, what happens to the market price changes in the short run? So, if the market price changes, the business will also have to adjust its decision on the quantity of goods where they'll sell and produce. So, according to the profit maximizing rule, they always produce at a quantity where marginal revenue is equal to marginal cost, regardless of changes in prices. Now, let us go on to long run costs of individual businesses. So, you need to understand what is long run. Long run is basically a period of time that is long enough for a business to change all of its vectors of production and inputs in order to adjust its level of output. This is a very important definition. So, in the long run, the business does not have fixed costs. All costs, we actually assume that they are variable. So, total costs are equal to total variable costs. So the relationship between long run average costs and long run marginal costs is the same as the relationship between short run average costs and short run marginal costs. You also need to take into account that the long run average cost is U-shaped. Why? Because when the level of output increases, initially the long run average cost they also decrease. This is what we call the economies of scale. However, over some time, these costs become constant. So we are actually going to see it in this diagram. So as you can see at this point, right, as we move down along this line, you can actually see that the quantity is increasing, right, on the output. However, the costs are actually reducing, right? Now, what does this mean? The more a business produces, then the less costs it actually incurs, right? This is your economies of scale. So, economies of scale basically refer to cost advantages that are experienced by a company when it increases its level of output. So, there is actually an inverse relationship between the per unit fixed cost and the quantity produced, right? Now, after some time, the business will just incur constant costs. Then, also after an extended time, they'll also start experiencing diseconomies of scale. So these economies of scale, they happen when a business or a company grows so large that the costs per unit increase. So it actually takes place when your economies of scale no longer function for a firm. And this is usually caused by organizational management issues as well as technical issues in the production process. Okay, so this is all there is in relation to outputs and your revenue concepts. In the next video, I'll wrap up on your normal profit, your economic loss, as well as your competition policies. Please also go through, uh, please make sure that you also visit the blog so that you can have a look at the past paper related questions. Thank you for watching and do enjoy the rest of your day.